welcome everyone to this Friday webinar. As you know, we have scheduled this webinar to understand Abakkus house view on markets, as well as various products that Abakkus has been managing over last many years. There has been recent underperformance, and Abakkus, as a fund house which is always known for generating alpha, is also finding it difficult to outperform the market over the last 6 months. They had covered this part very beautifully in their July newsletter, but we thought of doing this detailed webinar with Aman Chowhan, who is the fund manager across the listed space of all the funds that Abakkus has been doing over last more than 5 years, to understand what is the house view on markets from here onwards, and what is it that Abakkus is trying to do in various portfolios to ensure that there is an outperformance, and also obviously when markets are high, how this time when markets may go down, Abakkus is prepared to handle that. So these are some of the broad points that we will be covering in this webinar. To begin with, Aman, I would want you to cover the house view on markets at these levels, covering valuations, earnings growth, your portfolios, and where do you see overall macros and micros of markets from here onwards?
Sure. Thanks, Kamal, and good evening, everyone. Thanks for joining in today. Coming straight to the point, let's come to the markets first, and then we can discuss the portfolios and what we are doing. Very clearly, markets have been in a roll. You don't need anybody to tell you that. But what I would like to add here is that it's not just that the Indian equity market is doing well. Globally, markets are doing well, though there has been near-term volatility. But overall, it's been a bull market at most of the countries globally. And India is also participating in that. And in this participation, India obviously has done relatively much better than other markets because we all know the economic positives that we have. So the growth rates in India is picking up. Things are fine. We are doing well on the export front also, and various other positives which we'll discuss in detail. But in a nutshell, we know that relatively within the peer group of emerging markets, within the peer group of Asia Pacific markets, and overall as a globally top 5 GDP in the world, India is doing well, and that is getting reflected into the equity market returns that Indian markets have been delivering, especially since April of last year. So the rally which started of April of last year continues. There have been some hiccups, some major hiccups also, but Indian equities have taken it by the stride. Let's come to that in detail. So April of last year was the time when globally equity markets started to rally and Indian markets participated. And the trigger for this rally was that there were two large crises which happened, one in Europe, one in US, where there was banking crisis and the CSFB crisis in Europe. And in both these crises, the respective central banks intervened within a week's time, and they were able to meaningfully resolve this crisis. This triggered a risk-on rally globally, and Indian equities also has participated in this rally along with the global markets. In this rally, we have seen two major setbacks. One, I'll say not so major, but maybe a minor setback is when the election outcome came in. While nobody was fairly estimating a 400 plus kind of seat, but we all were expecting a decent majority. While Modi, as a, you can say, coalition managed to get into the majority, it was not a very clear majority for BJP. This to us could have resulted in some kind of profit booking. What we were expecting ahead of the election also was that even if Modi comes back, that was something which was a consensus state. Everybody globally, not just in India, was expecting this to happen, and there could have been a classic buy on rumor, sell on news kind of a profit booking. Not a correction, but a profit booking which could have happened once this came in. And this was especially because last December, when we had 3 state elections and where BJP won comfortably, it was very clear that at this central level also, BJP or Modi has the required popularity and they'll come back. And hence it was no longer a surprise. Whoever had to buy because of Modi coming back would have bought into equity markets in December, January, February, right? Nobody waited till June, July for the result outcome to buy. And hence it was a classic setup for a buy or rumor, sell on news kind of thing. But that did not happen. In spite of lower seats, market took it by the stride, bearing 2-3 days of volatility. Indian market stabilized. The other setback happened in the budget, where especially for equity investors, the capital gains rates got tweaked, and that was something which was also a trigger for markets to get into a profit booking mode. See, we are sitting on decent profits since April. Mid cap index is up more than 50%. Individual stocks are up anywhere between 50 to 100%. Mid cap funds are up more than 50, 60, 80%, depending on which fund you are into. Right? So we are sitting on decent profits, and this was a good enough trigger for at least some kind of profit booking to set in. But that has not happened, and that has surprised many, including us, the kind of resilience Indian equities have seen. While this can easily be explained that we have our positives and everything which is there, which we all know, but still we cannot have a market which month on month just keeps on rising, right? It cannot be a linear rising market, and hence we felt there could be some time corrections, we felt there could be some profit booking, but that has not happened. And if you have to ask me what is the primary reason for this, though we all are happy it's a rising bull market, but the primary reason for this is that there's good amount of retail liquidity, demand, interest, whatever word you use it, which is there in the markets right now. So while some months we saw even FIs selling, some months we saw a less amount of FI buying coming in, but the retail interest of the retail liquidity continues strong, both direct investments as well as via the mutual fund route, which includes both SIP and non-SIP investments. Now, keeping this in the mind, this is what we feel has been the biggest trigger, that whatever happens to the market, the retail mindset is that if there's a 1 day correction, 2 day correction, is an opportunity to buy. In the past, whenever they have done this, they have made money because markets have seen a V-shaped recovery at most of the time when there has been volatility. And this is something which is there in the retail mindset right now, that any correction is an opportunity to buy, which in a way is good, but that's what is fueling the, you can say, resilience of Indian equities right now. We have seen examples of this in the past also. We have seen something like this happen in the Korean market, something like this happen in the Thailand market also, where in spite of FI selling, the local demand or the local liquidity is strong enough to hold on to the markets, and looks like India is also experiencing the same. Now, keeping this in the backdrop, what is the stance that we have now? We feel Indian equities right now is, you can say, fairly priced. On the valuation front, we will be like 21, 22 times forward earnings, which is slightly about 10-year average, but not something which is like too poppingly expensive. At the same time, very clearly, we are not a cheap market anymore. The way it was, say, 2 years back or 3 years back, today I'll say the market is fairly priced. It's not either expensive that one should be too worried about, nor it is cheap at all. It's a fairly priced market, and hence from a fairly priced market, one should expect a fair return. For us, a fair return from Indian equities, even from this level, if somebody has to look at Indian equity, even from this levels, a mid-teen kind of a return is still possible from Indian equities, for the simple fact that this is what the corporate earnings growth in India is. See, the maths is pretty simple. 6 to 8% of the GDP growth, 6 to 8% of the inflation, so the nominal GDP is around 15, 16%. This is what the corporate earnings growth is. In fact, the corporate earnings growth selectively should be higher than the GDP, because in India right now, what we are seeing is that the formal sector of India is gaining market share versus the informal sector of India, and hence the corporate earnings growth should be a slightly better number versus what the GDP growth is. So keeping this in mind, while we have a decent mid-teen kind of a corporate earnings growth coming in, and this looks sustainable, at least for the next few years, this rate of growth is sustainable, and hence that should be a fair estimation of returns from the equity markets. In the past, we have made a much better return because there has been a meaningful PE re-rating which has happened in the markets. What used to be a 15, 16 PE market today has become 21, 22 PE, and that has fueled the returns that we have got. Can this PE rise further? It can rise further. In the past, we have seen 23, 24 times also in Indian equities, and there is no reason why we can't reach or even breach that number. So if markets had to continue to rally, Indian equities can be justified even for a 25 PE, because right now, frankly, we are in an oasis of growth. There is not much of growth globally. US is soft, Europe markets are soft, and among the larger economies, India is the best performing economy, and hence we can justify a slightly more premium than what we have seen in the past. And this premium is also justified because, for a very simple reason, that in the past, whenever India saw GDP growth, it was predominantly consumption. Domestic consumption, private consumption, government consumption, that was the main center point. This time around, the growth has more legs, and it is much more sustainable, because along with consumption, we have also seen capex happening in most of the companies, most of the sectors that we speak to. They are all expanding the capacity. So that is something which is picked up. Definitely, manufacturing is picked up. Make in India, Atmanirbhar Bharat, which was slogans a few quarters back. We have seen ground action, and we have seen the impact of this at the ground level, and that is also helping in the capex activity. So consumption is there, capex is there, manufacturing is picking up, and because of China plus one, where globally people are reducing their dependence on China, we are also seeing exports picking up. So earlier, India was known for IT and pharma. Now even textiles is picking up, garments is picking up, chemicals, even things like basic bathroom tiles, which earlier we used to import, now we have started to export. So we are seeing pickup in the export also. Because of this, the current, you can say, economic growth has much more legs, much more sustainable, and hence we can justify a higher P for Indian markets versus the past, and we are nowhere close to that. So clearly, this message is very clear from us. This is what the house view is, that Indian equities, though we have seen a decent rally, can still continue to deliver, but if you're looking at the past 12 months return of a 40-50% and expecting the same thing to happen, you might be disappointed. It's a fairly priced market. Expect a fair return, not an abnormal return. If for some reason, that's what the equity upside is. If for some reason markets were to re-rate, there is something which the government does, something happens globally, and if you have to get a better return, happy for you, happy for us, we all are happy. But at least that should not be the base case. See, you come with a market with a 30% return expectation, you make 20%, you are unhappy. You come with a 10% expectation, you make 20%, the same 20%, and you are happy. So that is what the message we would like to convey, that you can still make decent returns. A mid-teen kind of a return is still decent versus other asset classes. And plus, you have the option that something can get triggered, something the Modi government can do, and which can give you even a better return than these, which is the normal, I can say, corporate growth earnings return. Now, what can trigger a higher return than what we feel is that this is going to be the third term for Modi, and most likely this will be his last term as an official PM. He'll continue to be a strong BJP leader, but he might not be the PM candidate if the BJP has to come for the fourth term. So Modi is maybe very clear about this, and he'll take the right steps. This is where he would like to push the gas, or he would like to push the acceleration. What India needs now is that we need some big bang reforms. We have seen GST, we have seen Demon, we have seen efficiency of taxation coming in, we have seen various reforms with the government, but now we need to touch one or two of the touchy issues, which is like legal reforms, where the government has already made considerable progress. We need land reforms, we need labor reforms. Any progress on any of these reforms front can be a catalyst, can be an additional trigger for the markets to deliver better than the mid-teen returns. So that's broadly what the setup is. Modi has to deliver for us to make a decent return. If status quo continues, we continue to do well as an economy, and Modi continues to do well the way he has been doing for the past several years now, a decent return from equity market should be expected. Now, this is the setup, this is what we are, and this is what the market outlook is.
Sure, Aman. I think this was really insightful. So, from here onwards, how are you managing the underlying beta and underlying the alpha, which is expected in the portfolios given various scenarios? So, because many of the clients who are invested in Abacus, they see least amount of churning happening in Abacus, which is like good, for the time being. But at the same time, investors want to know, what is it that you're trying to do? Because, obviously to generate alpha, you have to bring in some changes in the portfolio. If your portfolio is showing some signs of, some exuberance in certain sectors whereby some returns have come, are you making any changes? Or if you're not making any changes, what to kind of expect ahead as kind of a further future unfolds? Because over the last 6 months, there has been underperformance. I understand markets have been under momentum and you may not be wanting to chase momentum, but at the same time, there has to be some strategy in place for Abacus to continue to perform and outperform the benchmark.
Sure. So clearly, you're right. There has been a clear momentum in the markets, and we have not been chasing the momentum. Besides that, what we are doing in the current situation is such that we invest with a 3 to 4 year view. right? So at the time of investing, that is the investment horizon that we have. So for us, long-term investment is not 10 years. It is neither 1.5, 2 years. It's 3 to 4 years is what the investment horizon that we have when we invest. And that is the reason you will not see much of churn into the portfolio, which is good over that 3 to 4 year period. So in the last 12 months, there have been good momentum in the market, and we have not chased this momentum. And this momentum is predominantly in three sectors, which is defense, PSUs, and railways, and overall in the mid and small cap segment. Now, we have very limited exposure into the three segments that are doing well. First is the PSUs. Frankly, we are not a very big PSU lovers. These are decent companies, but their business models, their margins, everything is dependent on the government. If the government is doing well, these companies do well. But we all know the labor, we all know the leadership challenges the PSU companies have. And hence, we are not a very big fan of PSU companies. Hence, we have very limited PSU exposure into our funds. Bulk of our PSU exposure would be limited to the large PSU banks that we have, which are very efficient banks, where we are very clear that these banks will continue to do well. No economy can grow if the banking sector does not participate. And the size and the scale of PSU banks is such that if India has to do well, the PSU bank also has to do well. And there is a reason we have PSU banking exposure. Besides that, we don't have much of PSU exposure as such. Coming to railways, there are no large companies in railways, and hence we have small, you can say, mid to high digit, single digit railway exposure in our mid and small cap portfolios. The third thing is defense. Defense is something that has done very well, both the PSU names as well as the private names. And here also we have very selective and very limited exposure for a simple reason that the valuations of these defense companies today are crazy. Most of the private defense companies will be trading at north of 40-50 P. Most of the PSU defense companies will be also north of 30-40 P. Now, this is not something that we are very excited about because, as we all know, Abakkus stands for value conscious style of investing. So while we are not a pure value investor, we are definitely a value conscious investor. We don't want to overpay for anything just because that's there in the momentum or there is hype around that company or that sector. And hence, we have very limited defense exposure. So this is what has happened in the last 12 months, where we have not blindly chased the momentum. Having said that, we have also participated in the mid and small cap rally that is going on, where our portfolios have moved along the mid and small cap markets. In the near term, there will be some underperformance. The underperformance is predominantly because for the new clients, there is cash in the portfolio. So any new client who has come into a PMS scheme, say over the last 6 months, he will be 70-75% deployed. Any new client who has come over the last 6 to 12 months will be around 80-85-90% deployed. They are not fully deployed. The reason for this is that we are taking time for deployment because that's the way our style is. Even if it was not a bull market, we take time to build onto the portfolio. We don't blindly have a model portfolio concept that we get money on Monday and on Tuesday morning that whole money gets deployed as per the model portfolio. So we have a model portfolio, but we are selective within the model portfolio as to when to buy, what to buy. If something has moved up in the near term, we would like to wait before just blindly jumping into that name, or we might look to have a relatively better name coming into the portfolio. So for this reason, we have taken time. There is cash in the portfolio for this reason. And this cash is that not that we are worried for the market, but definitely we are worried the way the markets have moved at the speed of the market. I'm not worried with 25,000 index level. Today or tomorrow, that index level is going to get breached also, right? That is not the worry. It is not about that valuation is too expensive. Just that the speed at which we have received this levels of 25,000 index is something that was not very comforting, and hence we didn't want to just blindly get into the markets. So it is because of this cash into the portfolio is where you will see some kind of drag, and that is where the alpha is got.
Sure, Aman. Subsequent question, that comes to mind is that when you guys do your internal review meetings, as investment committee meeting would have been happening and markets have been kind of delivering a lot of returns in the defense, PSUs, railways, you mentioned that your exposures are less. Have you guys not felt that, it's a regret because these sectors are also value, and you mentioned that you are a value conscious fund house, and don't you think that you have missed that part? Aman, can you hear me? Aman, can you hear me?
Yeah, Kamal, I can hear you.
Perfect. So, did you hear the
Sure.
question? Should I repeat it?
Yeah, I got the question very well. See, in hindsight, yes, we can say that we could have had a higher PSU exposure because there was value in the PSU name. Yes, definitely there was value. But at the same time, as we have been constantly saying this since inception of Abacus, that we are not a pure value investor. We are value conscious, but we are also growth investors. So we will not buy anything just because it's a 5p stock or a 5% dividend yield stock. We would like to invest into companies where there's a decent growth, and for that growth, we don't want to overpay. In PSU names, the growth was there, but it came all because of government action. And in the past, we have seen what has happened with ONGC, HP, BP, IOC, and various other companies. The way it happened with Shipping Corporation, or the way it is happening with Dredging Corporation, or the way it is happening with other PSU names where there was some divestment which was expected and that has not materialized for a long period of time. Same way, we didn't want to go overweight because of that, and hence we restricted our exposure to the PSU name. Yes, the market has rallied, stocks have done well, no doubt on that. But at the same time, everybody has some strategy, everybody has some style. Our style is that unless and until we are pretty convinced, we will not like to chase momentum, and that's the way we have handled the portfolios.
Sure. Given that your portfolios are value conscious and markets over last 5 years, maybe 3 to 5 years, has more into that value style of investing, and it's like a equity markets are cyclical, and we have seen growth style working really well before that because interest rates kind of went down, and then they came up from 2022 onwards. Value investing became all the more popular because market became value conscious after interest rates went up again in the US to say all-time highs of 5.5%. And now from here onwards, maybe after elections in the US, interest rates may again start to go up. As it is expected that in September there will be first rate cut, so interest rates may start to come down, not go up. So when interest rates will start to come down again, value conscious investing may take back seat, and maybe growth focused businesses which are like the ones which have been ignored over last some quarters, they may start to perform. So given that juncture, are you going to make any changes in the portfolio, or you will stick to the course and wait for again a wheel to turn, because that could lead to a period of underperformance? And investors want to understand should they kind of book profits and maybe convert money into cash and into some other portfolios, or you will do changes at your end if you feel that this kind of change is happening in the market?
So clearly, these are active portfolios. So we take whatever corrective as well as proactive action that we have to take. As we speak, we are increasing our exposure to financials, though we are where now it's a consensus call that there's going to be rate cut in US. We are not expecting any major rate cut in India because India never witnessed that kind of rate hike the way US happened. From US, rates went from 0 to 4, so it was like a 4x rise, and from 4 they can come back to 3 or 2.5. India, that never happened, but nevertheless, India will also see some kind of rate cuts over the next 6 to 12 months, and we are prepared for that. Financial as a sector has also been market performer only, and hence there's decent value opportunity as well as growth in that sector. So we have increased our exposure both to banking as well as non-fund based financial stocks like AMCs or wealth management companies or broking companies. So we have done that. We are gradually increasing our pharma exposure. We are still neutral on IT, so we have a single digit exposure on IT, but we continue to stay that. We are very actively looking at that sector also. So along with pharma, IT is something that is waiting on. We continue to have decent exposure into industrials, and that stance will stay. So if tomorrow the markets, you can say sector rotation happens, or the market comes in favor of financials just because of rate cut, I believe we are adequately prepared for that.
Sure, Raman. So, this question is particularly regarding Abacus Emerging Opportunities AIF, which was started before COVID, and a lot of money came during COVID, and people have made a lot of returns. It's like investors are sitting at 3 times, 4 times, or even 5 times, depending upon their time of entry. And these portfolios today are like, out of hard lock-in. and investors are wanting to know, should they be booking some profits at these levels, because obviously they have made a lot of money and small mid caps are at their highs, or there is an internal strategy that you guys have, because now when people have made so much money and there is no hard lock-in, ultimately these are closed-ended funds where sooner or later you will have to return the money back to the investors. So should investors wait for you guys to return the money? You have a strategy in place, or you are like wanting investors also to kind of take call at their end if they are wanting to do that, because markets are high and depending on investors' own call.
Sure. So we don't take calls on the market, or we don't take cash calls. From here on also, as I explained, we expect decent returns on the equity market. It might not be eye-popping the way the emerging AI has been in the last 5 years. The fund is up 4x, so it might not be that eye-popping, but still a good, decent return can be made from the market from these levels also. And that is the reason our suggestion would be, if somebody is not in need of money, then he can continue to be in the portfolio. Indian equities are expected to continue to do well. It might not be a linear rally that every year will make very strong numbers, but eventually over a 3 to 4 year horizon, the way it has happened with the AIF that we are discussing, that over a 4 to 5 year period, it's been a 3x return. Over the next 3 to 5 years also, we'll have a decent alpha and we'll have a decent return. So that expectation is still on. And ultimately, it is the investor's call, because we will not take a call on the market or on cash levels.
So here onwards, what are the risks that Abakkus is cognizant of? There were certain events that kind of got unfolded. You started the call by saying that last 1 year was a good period, but there were two kind of disappointments. One was elections and second was budget. But in future, what are the couple of events that you guys have in mind which you think one should be watchful towards, in terms of upcoming risks?
We feel the rest of the market is more global than local. Locally, there is not much to worry about, except for one point, that the bottom of the pyramid demand in India is still weak because of the inflation. Maybe your and my lifestyle would have not changed. We would have deferred some plans. But the bottom of the pyramid guys, say our staff who earns 10, 15, 20, 30,000 rupees a month kind of thing, their spending and their lifestyle has changed because of the high inflation. And there is a slowdown in this segment, which is what is reflected in the, you can say, consumer demand also. So if you see HLL or Leo, that segment, they are seeing single digit demand growth, right? So that's where there is some slowdown in the market. This is the only, you can say, weak patch in India right now. Monsoon also has been decent. Having said that, this segment is also expected to improve because monsoon has been decent, and most of the companies that we speak to, they're expecting the current festive season to be better and the demand to pick up slightly before that. So everybody is expecting that the second half will be much better than the first half. So I don't see much of risk from a local standpoint of view. Risk to Indian equities would be predominantly global. We have seen in the past, wherever there is global volatility, Indian equity markets, though relatively outperform, but at least they also witness same kind of volatility. And that is where the risk is. There is geopolitical risk. We have seen that happening with Russia, with Israel. It can spread out to the Middle East region. There can be some hiccups because of that. There is going to be elections in US. We all know about that. If there is any surprise there, or if there is any change in US policies or something, and the US markets were to correct because of that, Indian equity markets will also face a headwind because of that. These are the known, you can say, risks, which are global risks. And as we all know, risk is predominantly something that is unknown, or it comes as a surprise. So there can be some surprise also on the global front end. So net, the call is that risk to equity is predominantly global than local. Locally, I don't see there is much of risk because the bulk of the major risk, the election as well as the election budget, is now behind us.
Sure, Aman. We are moving to the last segment of this webinar. So tell me one thing, there has been this research done by various companies which claims that, as AUMs of a particular fund, it could be any structure, could be a PMS or a mutual fund, they go up. Beyond a point, it becomes difficult for that, fund to ultimately keep outperforming. Alpha is something, which every investor, specifically when they give money to Abakkus, is they kind of look forward to. From this point of view, we do not see, in the PMS structure, Abacus kind of coming to a point where they say that we are stopping to take money. We are not taking any new money, especially in the mid and small cap bias fund. And today now your PMS AUMs have kind of grown maybe closer to 5,000 crores each, both in all cap and the emerging opportunities portfolio. So from here onwards, those new investors who are coming, or even existing investors at such large AUM, how will you continue to outperform? How will you continue to kind of give alpha, given the size of the fund? Have you guys, internally discussed this aspect, or you are cognizant of this? At some point of time, you will stop taking money, or it doesn't matter at all. All those research reports which try to claim that yes, rise in AUM here has inverse relationship to returns.
Kamal, you are right that after a certain size, it does become you can say difficult to generate a meaningful alpha, because it is not so easy to maneuver a fund. It is much easier to maneuver a 5 or 10,000 crore AUM than maneuvering a 30-40,000 crore AUM. So we are aware of that. Right now, we don't feel we are anywhere closer to that stage. Both the PMS schemes that we have are sub 5,000 crores of AUM. The large cap or the all cap can easily be 2-3x of the current size without impacting the liquidity or the you can say alpha generating opportunity. For the mid and small cap, also at sub 5,000 crores, I don't think we are anywhere closer to that. Internally, we'll take that call closer to when we feel that we are hitting a saturation point. But as of now, with sub 5,000 crores of AUM, we don't feel any need to take that decision. And also the fact that every week there is 1 or 2 new IPOs that are coming in. Every week there is companies that are getting listed in. So the market cap is also getting broadened. The number of investment opportunities are also rising, and that is also adding to more options and more you can say alternatives to look into. And for that reason, we feel that at least at the current juncture, we are not feeling, you can say, the liquidity pressure person.
Sure, Aman. I just moved to the last question. I had asked you that we'll do this webinar for 40 minutes because you were traveling. Thank you for your time. We are just moving to the last question. Abacus has recently launched a Category 2 fund. We did webinar last week with Ankit Agarwal. And, what is being claimed is that because valuations in the listed space are high, Abacus as the fund house is kind of more comfortable at this moment for new investors to deploy money in the unlisted space. You represent, Abacus, the listed side of it. Today, there are a lot of investors who would want to understand this from you. When you say that, yes, over the next 3 years also, there could be decent returns coming from listed equities. And obviously, you will find out a way to give those returns in listed equities. But at this juncture, if you had to put your own money in that, unlisted fund of Abacus, which is 428 Category 2 AIF versus any of your listed fund, how should investor kind of, evaluate, and how should investor kind of take that decision? If you are to put your new money, where will you put that money and why?
See, liquidity is a major criterion in deciding between the two funds, besides the temperament. The unlisted space is something which is suited for people looking at investments beyond 5 years, 5 to 7 years. That's what the tenure of the fund is also, and that's the nature of private equity business, that you invest in unlisted companies. These companies grow, prepare themselves for listing, and eventually get listed, and then you make an exit. And if you go wrong, then you're stuck, right? So the risk reward equation is very different for an unlisted or a PE fund versus a listed fund. If somebody has capital and the patience for the 5 to 7 year horizon, then the private equity fund definitely makes sense, because this is something which will generate a decent alpha over this time frame. But if somebody is unsure about the liquidity, they might need the liquidity, or they don't want to get locked up for that period of time, then listed equity space is the only space. As I explained, in listed market also we expect a decent return, a normal return. It's a fair price market and hence a fair return. In the PE space, just because you are being more patient, you are taking slightly higher risk compared to a listed equity, because if something goes wrong, then the IPO may not happen, and then the exit option is very limited. Unlike a secondary market, where if something also goes wrong, maybe at a 5, 10, 15, 20% lower, you will still get an exit option, right? So you're taking a slightly higher liquidity risk, you're also taking a slightly higher tenure risk, and hence your return expectation should compensate for that. And hence, if somebody is okay with that, then the PE fund can potentially deliver a higher return than the listed space. That's broadly what the call is.
Sure, Aman. I think it has been great and pleasure conversing with you. I have no more questions. Thank you so much for your time, and thank you everyone for joining us today. Thank you, everyone. Thanks, Aman.
Sure. Thanks, Kamal, and thanks everyone for joining us today. Any future queries and anything, feel free to get in touch with our team, and we'll be happy to help.
Thank you.
Sure. Thank you.